On November 7th, U.S. 10-year Treasury yields traded at 4.21%, just shy of the 14-year high set on October 24th. Since that time, yields have collapsed to a current level of 3.80. In the last 3 weeks, we've had three major economic data points: GDP, the employment report, and most recently, CPI. Interestingly, the first two looked higher than expected on the headline, but closer scrutiny revealed some potential inconsistencies. Now, the most important release was the November 10th CPI, which seemed to convince the market that inflation was finally beginning to slow, and that sent yields across the curve lower. Now, it's worth noting that the 2-year versus 10-year yield spreads remain consistently inverted, suggesting that the market still believes that financial conditions are tight and that there's a possibility that the Fed raises too far, opening the door to a potential recession and an eventual pivot to easing within a year. For reference on that, the CME FedWatch tool is now pricing in the possibility of an easing by September of 2023. If a trader believes that yields could continue lower from here, they could express that by selling the November micro 10-year Treasury yield futures contract at 3.80 and targeting a move to the June highs of 3.50. A stop for this trade could be placed above at 4.05. Now, this trade could make $300 if the target is reached and risks $250 if you're stopped out at your level. If a trader believes that yields could move higher from here, they could express that by buying the November micro 10-year Treasury yield futures contract at 3.80 and targeting a move back to the October highs of 4.24. A stop for this trade could be placed below at 3.60. This trade could make $440 if the target is reached and risks $200 if you're stopped out of your level.